Here's a simple truth. When gold rises, empires fall. And this has already happened. This isn't just something that happens in history books, it's a pattern that's been repeated again and again. And while many people focus on the chaos that comes with it, they miss the bigger picture. What's really happening right now is the biggest shift of wealth in history, and it's already underway. You see, when an empire collapses, it creates more millionaires than when it was at its peak. But only those who understand the right blueprint benefit from this shift. There's a hidden system in place, right in front of us, that decides who gets wiped out and who ends up wealthy. And this system was made by the powerful for the powerful. It works off one key thing, the devaluation of money. We've been taught that money is complicated. They want us to believe it's all about markets, inflation, and what the central banks are doing, but that's the lie. The truth is much simpler and way more brutal. When a government runs out of money, it doesn't stop spending. It just prints more money. And when that happens, the value of the money we've saved shrinks. This is an invisible theft, and it's what's caused every empire to collapse. The real sign of this theft is gold. Gold doesn't change, it's always there. But the currencies we use to buy it, they lose value. When you want to understand how bad this theft is, look at gold. It stays constant, while the money we use to measure it falls apart. To understand what's coming, you need to see the bigger picture. This isn't some wild theory, it's something that's happened over and over throughout history. Let's take a look back in time so we can see how it all plays out. We'll watch Rome fall, rotting from the inside. We'll see Spain flooded with more silver than any empire before it, yet still crumble into poverty. The Ming dynasty thought they could replace gold and silver with paper money, and it cost them everything. Even the British Empire, the world's biggest power, lost it all in just one weekend. And now we're here today, in the United States, where the countdown has already started. Let's start with where this blueprint first took shape, Rome. For Rome, the backbone of its money wasn't gold, it was silver. They used a coin called the denarius, introduced around 211 BC. For a long time, it was the most trusted currency in the world. At its peak, it was almost 95% pure silver, with each coin weighing about 4.5 grams. You could hold it in your hand and know exactly what it was worth. For almost 300 years, Rome kept the denarius stable and the empire thrived. But, as history shows, governments can never resist the temptation to overspend. The temptation to promise more than they can deliver. The temptation to cheat. And it began slowly, almost unnoticed. By the time Emperor Nero came to power around 60 AD, the silver content had already been reduced to 90%. Under Emperor Trajan, it fell to 85%. By the time Emperor Commodus ruled in the late 100s, it had dropped to 70%. And by the early 200s, under the Severan dynasty, the denarius was only 50% silver. The government was minting twice as many coins from the same amount of metal, stealing half of the value from its people through an invisible tax. Then came the breaking point, the crisis of the 3rd century. This is where the blueprint became set in stone. The emperors, desperate to pay their armies and fund endless wars, threw all caution aside. By 250 AD, the denarius had less than 5% silver left. It had become a joke, just a copper coin with a thin silver coating that rubbed off in your hand. And the people weren't fooled. You can't trick a market, especially people just trying to feed their families. The soldiers, the backbone of Rome's power, started demanding to be paid in gold instead. Historians say that prices in the empire skyrocketed by over 1,000% in just a few decades. And here's where the rule really kicks in. A single gold coin, the aureus, which had once been worth 25 denarii in the early empire, was now worth thousands of denarii. By the time Constantine attempted to reform the system, the aureus was worth millions. Gold didn't double. The denarius collapsed. It was the market's final vote of no confidence. And as the rule goes, the empire followed suit. The political chaos mirrored the monetary chaos. Between 235 and 285 AD, Rome had around 26 emperors in just 50 years. Most of them were murdered. The empire split apart. Trade collapsed. Taxes went through the roof to pay for worthless money. In many places, people turned to barter, trading wheat for shoes instead of using currency. The lesson is clear and timeless. When a currency loses value, gold rises and empires fall. Rome wrote the first chapter of this story, but it certainly wasn't the last. After Rome, the blueprint repeats. this time in Spain. We fast forward to the 1500s. Spain is the world's leading superpower. They have colonies across the globe, and most importantly, they control something no one else does: the treasure fleets. These fleets carry unimaginable riches, including silver from Bolivia and gold from Mexico. The Spanish ships haul tons of bullion across the Atlantic. At its peak in the late 16th century, Spain was importing more than 200 tons of silver each year. Historian Earl Hamilton, who studied this period, documented what happened next in a phenomenon called the price revolution. Spain believed it had found the perfect shortcut. Instead of producing goods, it could just buy them. But when you flood the market with that much new money, real silver money, no less, and don't increase the production of actual goods, you get massive inflation. From 1500 to 1600, prices in Spain quadrupled. Grain, wool, rent, everything became far more expensive. For the average family, this was a complete disaster. But here's the key point. Even with all that treasure, the government still couldn't control its spending. King Philip II waged endless wars, funding them with debt and using future silver shipments as collateral. But it was never enough. In 1557, he defaulted on his debts. Again, in 1575, 1596, and 1607, 4 defaults in just 50 years. The richest empire in the world was sinking under its debt. So what did they do? Exactly what Rome did: they debased their currency. Spain began issuing copper coins called vellon and told the people they were worth the same as the old silver coins. But the market wasn't fooled. The gold and silver, the real money, doubled in value compared to the new worthless copper currency. The wealthy, the landowners, and the creditors hoarded the real money, gold and silver. Meanwhile, the middle class, the poor, and the working people were left with nothing. They held on to copper coins while the price of bread skyrocketed. And what happened next? Just as history shows, the empire collapsed. Spain lost its global dominance. The Dutch and British, who had built solid economies, rose to take over the world stage. Spain was left in ruins, an empire that once held all the world's treasure but still went bankrupt. Once again, the rise of gold and silver wasn't a sign of prosperity. It was a signal that the empire was finished. But the story doesn't end with Western empires. Let's look at the 14th century in China, the most advanced economy of its time. The Ming Dynasty tried something no one in the West would attempt for centuries. They abolished gold and silver as currency. They thought they were smarter than the market. In 1375, they introduced the world's first major government-mandated paper currency, the Daming Baocha, the Great Ming Treasure Note. On paper, it seemed like a brilliant idea, a way to manage the economy, fund state projects, and create a modern system. But what did they do? Exactly what Rome did. They couldn't resist the urge to print more money. To fund their military and grand projects, they kept printing more and more. But here's the catch. These paper notes were not backed by gold or silver. Their only value came from the government's promise. And by the early 15th century, that promise was worthless. The paper money faced hyperinflation, losing more than 99% of its original value. The people saw through it. They knew they were being robbed. They refused to accept the notes. The government's plan had backfired. So what did the market turn to? What did the people demand as real money? Silver. The entire Ming economy, by the force of the people's will, shifted back to silver. Silver became the real money. The government had no choice but to accept it, even demanding taxes be paid in silver from the 1560s onward. For a while, this worked. Silver flowed in from Japan and from the Spanish-controlled New World. But in the early 17th century, the final act of this blueprint began. That flow of silver stopped. Japan closed its doors. By the 1630s and 1640s, Spain was in decline and cut off its supply. Suddenly, China was deprived of the one thing its economy had come to depend on. Silver became scarce, and its value skyrocketed. Against the copper coins that peasants used in daily life, silver didn't just double in price, it tripled, it quadrupled. This was the tipping point. The peasants earned their living in copper, but the state demanded taxes in silver. A huge gap had opened. They were wiped out. Famine, crushing taxes, and desperation sparked a massive peasant rebellion led by Li Zicheng, which toppled the Ming Dynasty in 1644. The rule held true. It doesn't matter if it's a silver coin, a copper coin, or a paper note. When the trusted hard asset gold, or in this case, silver, doubles in price against everyday money, it signals that the system is broken. The empire falls. And so, the blueprint lay dormant, only to reappear with the next empire. Let's fast forward to the 1900s. The British Empire, the empire on which the sun never set. Their money, the pound sterling, was the global reserve currency, backed by gold, with London as the financial center of the world. It was the denarius of its time. But just like every empire before it, war and debt began to slowly rot the system from within. World War I forced Britain to suspend the gold standard in 1914, a temporary measure that became permanent. They printed more money to pay for the war, which devalued the pound. They tried to return to the gold standard in the 1920s, but the confidence was gone. Then came World War II. By the end of the war, Britain was victorious but financially exhausted. It became entirely dependent on loans from a rising power, the United States. In 1944, at the Bretton Woods Conference, the new global financial system was set up. But it wasn't built around the pound. It was built around the US dollar. The dollar would be pegged to gold at $35 an ounce, and every other currency would be pegged to the dollar. The pound was set at a proud but artificial rate of 43. Britain was essentially pretending that its money was far stronger than it really was. And as always, you can't pretend forever. The market always finds the truth. By the late 1940s, Britain was losing dollars fast. It couldn't export enough to pay for its imports. The world knew the pound was overvalued. The breaking point came on September 18, 1949. In a single weekend, the British government had to make a drastic decision. They devalued the pound by 30.5%, dropping the exchange rate from $4.03 to just $2.80. Think about what this meant. Since the dollar was still tied to gold, this move meant that the pound was effectively devalued against gold as well. The price of gold in pounds shot up by over 30% instantly. This was a brutal market correction, signaling something much bigger. It wasn't just a financial adjustment. It marked the end of the British Empire's dominance in the global financial system. The pound was no longer the world's anchor currency. The torch had passed and a major shift was underway. Now, the blueprint was in America's hands. The story shifted to the US dollar, which had replaced the pound as the world's reserve currency. The Bretton Woods system, set up in 1944, was America's deal with the world. The US promised that the dollar was as good as gold, $35 for 1 ounce of gold anytime. This made the dollar the global standard. For a while it worked. The world rebuilt and everything seemed stable. But just like every empire before it, the US couldn't resist the temptation to spend. By the 1960s, the government was funding the Vietnam War and huge social programs at home. And instead of paying for them through taxes, they printed more money. The US was sending out billions of dollars overseas, far more than the gold they had to back it up. The rest of the world wasn't fooled. Countries like France, led by Charles de Gaulle, started calling America's bluff. They began sending their dollars back to the US and demanding gold in return. And America had no choice but to pay. Then came the crucial moment, August 15, 1971. President Richard Nixon went on TV and announced that the US would no longer allow foreign central banks to exchange dollars for gold. He shut down the gold window and effectively ended the last link between the dollar and gold. With that one decision, he tore up the contract that held the global financial system together. From that moment on, the US dollar and every currency on earth became fiat money, backed by nothing but the promise of governments. So what happened next? Gold was finally set free. It could no longer be pegged to $35 an ounce. Its price shot up. By 1973, it was over $70. By 1974, it was $180, and by 1980, it hit over $800. This was the moment gold doubled in price, and that was the signal. The canary in the coal mine. Just like Rome, Spain, and Britain before it, this moment marked the beginning of the end. The dollar was no longer stable, and it set off a global countdown. For the first time in history, all currencies became pure fiat money, backed by nothing except trust in governments and mainly faith in the US dollar. But as we've learned, trust is fragile. Fast forward to today. After the 2008 financial crisis, decades of wars, and the massive money printing of the 2020s, that trust is starting to collapse. The US national debt is an enormous problem. The system is rotting, just like Rome's did. And now people are starting to look for an alternative. They feel the devaluation happening. They know something is wrong. And just like in past cycles, a new solution appears, a digital gold Bitcoin. It's being sold as the ultimate escape, a decentralized, anonymous, peer-to-peer system free from the control of governments that have been devaluing our money. Bitcoin is a digital snare, designed to capture those who saw the collapse of fiat money but weren't wise enough to recognize the real solution. Think about it. What does Bitcoin actually depend on? It requires the internet and infrastructure controlled by the powers that be. It needs the power grid also under their control. It relies on digital exchanges to have any real-world value, and those exchanges can be shut down, frozen, or seized in a single day. The powers that be can turn Bitcoin to zero overnight, not by hacking its code, but by cutting off the on-ramps and off-ramps. They can make it illegal to transact. They can shut down exchanges. They can tax it at 90%. It's the perfect trap. They've watched Bitcoin grow for over a decade, identifying every person, company, and nation looking for an escape. And they've convinced them to trade their real wealth for a string of code. Bitcoin is just a digital ghost. You can't hold it. You can't bury it. And if you can't physically possess it, do you really own it? So if Bitcoin is a trap, what's the real solution? What have the truly wealthy always used to survive moments like this? It's the one thing they don't talk about. It's not something you can create with a keystroke or delete with a line of code. It is the one asset that has survived every empire as collapse for over 5,000 years: gold, silver, and real tangible assets. This is the generational arc. While they're busy herding people into a digital system, the oldest and most powerful families, the central banks themselves, what are they buying? They're buying gold more than ever before. They're bringing their gold back to their own vaults, repatriating it. They're not buying strings of code. They're buying heavy gold bars. They tell you one thing, but do the complete opposite. That's the signal. When the Roman denarius collapsed, the wealthy held gold and land. When France's assignats became worthless paper, those who survived had hidden gold. When the pound was devalued, those holding gold saw their wealth protected. This is the playbook. Gold is your defense. It's your insurance against the inevitable collapse. It doesn't make you rich, it keeps you from becoming poor. Silver is the practical money for daily trade. It's divisible, useful, and has been in circulation for thousands of years. And then there are other real assets, rare earth metals, land, and things you can physically touch and use to build the world. These are the true assets, the things you can stand on. The coming transfer of wealth isn't about finding the next digital token. It's about protecting what you have from the devaluation they've already set in motion. It's about trading their paper promises and digital ghosts for real-world value. If you can't hold it in your hand, you don't own it. That's the rule of survival. The blueprint is clear. The signal has been given. Gold has doubled. The empire's money is broken. The only question left is, will you be part of the greatest wealth transfer in history? Or will you be like the Romans, holding worthless coins?